I'd like to bring the mortgage committee meeting to order, but do we do some kind of roll call to know exactly who is here? I see Heidi.
Sure, I can. Do you want me to go through the members of the mortgage committee?
Yeah, that would be great. Thank you.
Wendy Clark is not going to be, I don't think she's going to be joining us. Heidi DeWinger. I know she's here. She may be muted.
I think you're muted, Heidi. Can you,
Okay, sorry, here.
Okay, great. Okay.
Ann Foley, Kylie Goslin. Here. Sayla Mascara Bruno. I don't think Sayla has joined yet. Lisa Tepper Bates. And Greg Ugalde, although he's not formally on the mortgage committee yet, he has joined us.
I think as of this morning, I may be. I had my meeting yesterday and or the day before, so I think things are catching up. But yes, I think I'm on the mortgage committee.
Yeah, good morning, everyone. I just wanted to extend a welcome to the newest member of the board, Greg Ugalde. He has recently been appointed to the position by the Senate Minority Leader's Office. He's the president and chief legal officer of P&M Building in Torrington, Connecticut. He's also the immediate past chairman of the National Association of Home Builders. And he served on the National Association of Home Builders board and executive committee for 14 years. So welcome, Greg.
Thank you.
Welcome, Greg. We're very glad to have you. And you go by Greg, not Gregory?
Yes, please. Yes.
Oh, wonderful. Okay. So I do think that for, I don't know if Greg is an official member or not. Do we have a quorum?
He is an official member.
Okay. So I'm quite sure that 4 is sufficient.
Yes.
And I'm sorry, I just joined as well.
Oh, great, Lisa. Okay. Wonderful.
Wendy Clark as well.
Oh, great. Okay, so we have a pretty full complement. Thank you all for joining. Okay, so I will convene the meeting of the mortgage committee this morning, and we will start with Wendy on Brookside Village Apartments in Stonington.
Good morning, everybody.
Good morning.
The request before you is to approve a prepayment of the CHFA loan on Brookside Village Apartments. Brookside Village is 160 unit development located in Stonington. It is a Section 8 property with a half contract that expires in July of 2034. Navigate Affordable Housing Partners administers the half contract on behalf of HUD. The owner and the management agent are Gilbane Development Company, and they're out of Rhode Island. Gilbane companies are involved in the development, construction, and property management of multifamily properties. Their projects include affordable housing, student housing, mixed-use communities, and market-rate housing. They have owned this property since it was built around 1985. That's when the original loan closed. It's the only CHFA financed project in their portfolio and their only property in Connecticut. At this time, they intend to sell the property. The current balance on the loan is approximately $1.4 million. The interest rate is 9.5%, and the maturity date is November of 2022. The affordability is maintained through the half contract that goes through 2034, but we will also be putting a restrictive covenant document on the property, which will it will require the affordability. Sorry about that. And in addition, it will give CHFA the opportunity to review a proposed buyer. The property has been well maintained, and the owners have completed many upgrades, especially in the last 10 years. They've done siding, windows, doors, boilers, asphalt repairs, fire alarm upgrades, and the units are upgraded as they turn over. As part of the prepayment, we will receive a housing program maintenance fee of approximately $23,000. Are there any questions?
Other questions for Wendy?
No, so just basically they're just going to prepay the debt that's owed, and so it'll have no debt on it, and they can sell it.
Correct. You
Is
did
the
talk to them. Go ahead.
I'm sorry, is the understanding that the restriction will be placed on at the time the property is released, so that in the future it will be reviewed by CHFA as well?
Mm-hmm. Correct.
So does that run with the deed, or is it a contract, a standalone contract with the new buyer?
It's on the land records until 2034.
Okay, thank you.
This is typical when we allow prepayment. We'll put a restrictive covenant document on the property to ensure the affordability for a certain period of time.
Have they identified a buyer or purchaser?
They have not. They said they have been approached over the last many years at different times with different buyers. So they don't have anybody in particular right now, but they just feel that this is the right time for them to move forward with the sale.
I'll make a motion that we approve this resolution.
Okay, it was moved by Greg.
I'll second this.
Second. I'm sorry, was that Wendy?
This is Kylie. I'll second.
Kylie. Okay.
You want me to do the roll call?
No. Hang on. I just want to make sure that there isn't any further discussion or questions for Wendy Worth on it.
It's just a shame we're losing a 9.5% asset.
Well, I think in the future, we're looking at ways that we can engage folks before their, loans are coming due, so we can see what they need, and if there's a way we can refinance them to a lower rate, we might be able to keep those loans in our portfolio.
Right. Good thought.
Yeah.
But it's still remaining affordable for at least another 14 years.
That's
Right.
Right.
Okay, anything else? Any other questions, comments, concerns? If not, yes, Shelley, if you could call the roll. Right.
Wendy Clark,
Yes.
Heidi DeWinger,
Yes, approved.
Ann Foley,
Yes.
Kylie Goslin,
Yes.
Shayla Mascara-Bruno,
Yes.
Lisa Tepper Bates,
Yes.
Greg Ugalde,
Yes.
unanimous.
That's great, thank you all. And I think that we're going to move on now to Macedonia Townhouses, and Debbie is going to walk us through that.
Yes, good morning. I'm Debbie Alter. I'm a manager in the multifamily department. The resolution before you seeks approval of prepayment on the mortgage for Macedonia Townhouses in Ansonia using escrow funds that are currently held by CHFA. The current balance of this mortgage is approximately $66,500, and the payoff will include a program maintenance fee of $2,729. 17-unit family development. The mortgage was originally funded in 1995 in the amount of $275,000, and it will mature on August 1st, 2025. Property is affordable to households at or below 54% of the median income, and the affordability restrictions will remain on the property after the loan is paid off. The affordability on this one is guaranteed already by 3 different documents. One is a ground lease that terminates on July 23rd, 2080. The second one is an assistance agreement that was executed when the property was originally developed under the DOH Housing Land Bank Land Trust Program. That document does not expire. and the property will also remain subject to CHFA's declaration and agreement of restrictive covenants. Property was inspected by CHFA staff in December of 2019 and found to be in satisfactory condition. To minimize disruption on the residents, the owner has historically chosen to address capital needs as small projects as they have arisen, and they have not used any of the CHFA replacement reserves, escrow, and that escrow balance has continued to grow. The property insurance was paid in June for the upcoming year, and the property taxes that were due July 1st have also been paid, and there are balances remaining in those escrows, and CHFA also holds a residual receipts escrow. In 2019, the owner experienced a decrease in revenue and an increase in repair costs, which led to the debt coverage being slightly below 1.0. The owner would like to stabilize the financial position of the property by paying off the mortgage. We've had discussions with the owner. They are aware of funding opportunities with CHFA, and they have indicated that if there are large capital needs in the future, they may try to seek grant funding for that. They understand that the affordability restriction will remain on the property as well. Are there any questions?
Questions for Debbie?
Yeah, why couldn't they use the reserve escrow?
It's not that they couldn't, they chose not to.
But going forward, where do those funds just sit and with the property? I mean, how does that work?
Those funds will be credited toward the payoff.
Oh, okay. Okay.
Yeah, there's approximately $51,000 in the replacement reserve escrow, and that's going to be credited towards the payoff.
So but why not use those funds to stabilize the property? I guess probably they're pricing it out and finding out. Because I agree, the question would be, why not use funds that you already have if the goal is to stabilize the property?
Right.
Yeah, we had several conversations with the owner, and they just were not interested in doing the paperwork, doing a large scale improvement. They really prefer to do these things on a small scale, and they just were not interested in accessing the reserve.
So is Michael Santora on the line?
Yeah.
Michael?
No? Do you want Mike to weigh in?
Yeah, Michael has a little bit of history because this is actually a land trust, and the organization actually is thinking, is Michael only?
I am here, Commissioner, yes.
Okay, no, Michael. Could you just give a brief information about why the owners or the organization wants to do this?
I really can't speak to their current thinking. Debbie's better positioned to do that. What I can tell you is this property was originally purchased under the state's mandate land trust program back in 1991. So it is now and will forever be affordable. There is a restrictive covenant recorded on the land records requiring that provision. So regardless of the CHFA mortgage payoff, the affordability of the project is assured. It may simply be that the owner of the property wants to take advantage of private funding opportunities without CHFA oversight. Essentially, and Debbie can speak to this, our restrictive covenant remains in place, and compliance with that is relatively simple. CHFA compliance on affordability when you have an outstanding mortgage is a little more complex and more onerous on the owner. It may be that simple that they want to relieve themselves of some administrative burden. But from the Department of Housing's perspective, we are not concerned that the project will move to market under any circumstances.
Thank you, Michael.
Really, my question is around so CHFA. Is it my understanding that CHFA doesn't have an ongoing relationship with this property, or does? My concern is the oversight on the condition. While 73 out of 100 is decent, it's not great, and there's And if they're looking to get out from under CHFA oversight, which might include inspections, and they're not interested in using their reserve for that purpose, it just makes me a little nervous about the property condition moving forward. So are they under any sort of obligation to continue to undergo inspections either through CHFA or through agency?
Is Wendy still on the line? Wendy might know the answer to that.
Well, I can speak to the Department of Housing. Yes, they're still subject to inspection. When there's another administrator in place, he always takes a step back. That is, we subordinate our activities, in this case, to CHFA. If CHFA's restriction were to go away, then our compliance and monitoring would kick up, and they would still be subject to inspection.
How often would that inspection be, Mike?
Annual.
Okay.
And this is Masuda. If I can just add, so one of the things that we are looking at internally is process improvement and looking at the monitoring requirements, reporting requirements for smaller developments, 30 units and under. So right now our current process is basically, regardless of the size, we essentially apply the same methodology. And so I think there's an opportunity for us to go back and see what we can remove and shave off on the monitoring side without obviously compromising the monitoring. So we'll be coming back with some recommendations as we look at our, again, procedures down the road. But I just wanted to share that with Mortgage Committee, because this was consistent with feedback that we received from some of our smaller property owners that, the monitoring can be cumbersome, and we're open to that, and we're looking to see if we can bring some solution for them.
Deb, can you speak at all to Kylie's concerns about the, or maybe Wendy, I don't know who, about the ongoing,
ongoing monitoring?
Yeah, the property maintenance issue.
The physical state of the property. Is this something that's going to require a significant amount of work in the next couple of years? I mean, I know you said it has score 73. Kind of, what does that mean for where it stands today, and how that might impact, let's say, the next few years?
Sure. So the roof was done 8 years ago. The decks were replaced less than 3 years ago. The siding was found to be in good condition. The mechanical systems were in working order, but reaching the end of their useful life. And currently, the biggest thing the owner was saying they'd like to address is resurfacing and striping of the parking lot. So none of the issues were deemed to be life safety type issues at this time. They've done a very good job of maintaining things as they've arisen. As far as ongoing monitoring, I really would like Wendy to maybe comment on that. I'm not familiar with what happens once it's paid off.
Wendy, are you?
Yeah, I'm here. We won't have any monitoring responsibilities after it pays off. So it sounds like from what Mike said, then his monitoring would kick in.
Right. So we would be the only monitor on the project. It would be, again, subject to annual certification of affordability, which is much simpler on the owner side, as well as an annual inspection. Our experience has been, especially with the smaller projects, and those owners who like to do their activities in smaller bites, they like to use local contractors. They like to get the best price, not necessarily go through the CHFA evaluative process, which requires plans, bids and specifications, lowest responsible bidder. Those provisions would not apply under the DOH restriction. The owner can just go do what they want to do, and in many cases save a lot of administrative burden on a maintenance type activity. It very often, especially with the small guys, that's really what it leads to.
Mike, can you help me understand what leverage the Department of Housing has, what are, if the property continues to, or deteriorates, I won't say continues to, but if the physical condition becomes worse, then what kind of leverage does the Department of Housing have?
It depends on how far we would want to go, and we could go all the way to taking the property if it were necessary. Any and all provisions in between would apply. We could apply pressure to, again, for all intents and purposes, the state controls the land. We don't own it. It's owned by the not-for-profit. But again, if they fail to maintain the property and use it as an affordable property, we don't have a right to the buildings and improvements. We have the right to the land. So again, worst case scenario, we could take the land away from them. We would then be dealing with the owner of the buildings and improvements, which, although it's the same entity, it's through a different mechanism.
Okay, thank you. That seems significant.
Yeah. Our experience has been that yes, it is. That if we could take the land away from you, you generally listen when we tell you to do something.
Thank you. Other questions for Debbie?
I want to add one more thing. So we are looking at prepayment policy in general. One of the first things I heard when I joined CHFA was that there's some frustration, honestly, in the development community that CHFA never allows prepayment, and there's a long history. I'm not going to go into all of that detail right now, except it is obviously a pretty complicated issue. I mean, right now we're dealing with the CHFA, so it would be good to have a discussion at some point with mortgage committee kind of around what are some of the questions and or policy decisions we might have to consider when allowing payment. And, one of the things we've been thinking about is kind of in line with Brookside Village, which is paying off at 9.5% interest rate. Is there something we can do where we look at our portfolio and have a holistic approach towards properties that are perhaps coming up against their maturity date, 3 to 5 years, or are maybe nearing the end of affordability? What sort of approach we want to take? And certainly in this particular case for Macedonia, we had the same exact questions around what would happen if CHFA stepped away from this property, but it's just taking into account all of the information available, as well as a fairly contentious relationship between us and, between CHFA and the current owners. We just didn't feel like it made sense for us to hold up prepayment for a very nominal that is outstanding, given the large amount of reserves that are currently being held. So it took a lot of work to try to figure out what to do for us, and I think staff feels like this is a decent recommendation for the board to approve.
I would just say, and I totally support, looking at the prepayment policy. I think that's very appropriate to do. I would just note that the frustration, you mentioned that there's frustration that CHFA doesn't allow prepayment. I'm not sure that's, I think that's a misunderstanding, frankly, because we have prepayments come before us quite often.
All the time.
All the time. So I don't know if that's maybe a communication issue or something like that. But honestly, I feel like we do approve prepayments often, as Heidi said. So on this particular Macedonia townhouses, are there other questions, comments, concerns that people want to raise at this point?
No, just a very general question for my education. Is there typically a penalty associated with prepayments, a monetary penalty?
Yes, there is going to be a program maintenance fee that will be charged. In this case, it's $2,729.
That per unit, or is that total for the property?
That's for the property.
So usually 1%, right? I mean, that's standard in the marketplace for bank financing, a minimum of 1%. And maybe this can be addressed in the new products or new programs, strategic part of our plan that gives us a little more flexibility with documentation going forward that either allows for refinancing or allows for prepayments with larger or smaller prepayment penalties. I mean, it depends, but I think it's a worthy discussion.
I agree with you, and I also think that prepayment, while it's been allowed in the past, it has not been set forth in any kind of policy document or program term sheet. We don't have a refinancing program. We don't have a consistent sort of approach to it. It's been allowed in certain circumstances, I guess, and maybe that's just something worth looking at. And as you mentioned, Heidi, contextualizing in terms of our products going forward.
Yeah, and this is I think one of the things that should be. We can have this as a separate conversation too, but this project is, I think, a good example. Maybe where prepayment is allowed, we set some conditions as it relates to property condition, because oftentimes we're talking about properties that are close to the end of a 30-year, ability period. They're reaching the end of their useful life, where mechanical systems and major capital needs improvements are coming up. And my concern is that where, and I understand in this case DOH is there, and I'm fine with supporting this, but making sure that it has a physical condition property rating that maybe is higher, or maybe those things make the mechanical systems reaching into their system, that CHFA there's some assurance that there's funding in place, so that those are replaced prior to prepayment, so that not only is there still affordability being guaranteed moving forward in this case, but you also know that the property isn't going to start falling into disrepair shortly thereafter because there's either not inspections or, just in this case, which may happen, there's not reserves or funding to do that level of capital repair, and we've seen that in some of our older properties throughout the state. So that's my real concern, is that if we're going to maintain these properties, and we're going to allow for prepayment, which I don't have an issue with, that the property is positioned well to survive for another 10 to 15 years at least.
Thank you, Kylie. I think that's helpful. Anything further?
Debbie, what did you say the interest rate was on this?
I did not. I'm sorry, I don't have that in front of me.
Oh, okay. I thought I missed it.
Greg, is that something you need to know in order to vote?
I'm just curious because, I think a big part of what's happening, obviously, is the market is just, interest rates have never been more competitive. So I think that's why any time that you can consider a move that saves you money, you have to look at it. So I believe that's what's happening here as well, among other concerns.
Okay. I would, unless there's anything else, I would entertain a motion to approve the prepayment for Macedonia townhouses.
So moved.
Moved by Greg. Any second?
Second, Wendy.
Second by Wendy. Is there any further discussion? If not, I would ask Shelley to follow up.
Wendy Clark?
Yes.
Heidi DeWinger?
Yes.
Ann Foley?
Yes.
Kylie Goslin?
Yes.
Kayla Mascara-Bruno?
Yes.
Lisa Tepper-Bates?
Yes.
Greg Ugalde?
Yes.
Unanimous.
Resolution's approved. The last action item that we have is to approve the June minutes of the mortgage committee. So if you had an opportunity to take a look at them, and someone wanted to make a motion to approve. I would entertain that.
All of them, Heidi.
Moved by Heidi, any second?
I second it, Sayla.
Thank you, Sayla. Are there any comments, changes? If not, I would ask Shelley to call the roll on the minute.
Wendy Clark,
Yes.
Heidi DeRinger,
Yes.
Ann Foley,
Yes.
Kylie Goslin,
And I was not present.
Sayla Mascara Bruno,
Yes.
Lisa Pepper Bates,
Abstain?
Greg Ugalde,
Abstain?
3 abstentions.
Okay. The minutes are approved from June. And so now we'll move into some reports. And I just want to see what time it is. Okay, so we have plenty of time for reports. Michelle is going to start with the HTCC rating and ranking results.
Yes, good morning, everyone. I'm Michelle. I'm a manager in the multifamily department, and I am very happy to report to you this morning that we have concluded the HTCC round for 2020. By way of background, for anyone that is not familiar with this program, it is a program to incentivize businesses to make cash contributions to a nonprofit that sponsors housing programs for the benefit of low and moderate individuals and families. The Commissioner of Revenue Services will grant a credit against the taxes due by that business in an amount equal to a tax credit voucher that CHFA will issue upon conclusion of this round. Historically, we usually get $10 million a year for the program, and of that $10 million, we are required to set aside $1 million for workforce housing, $2 million for supportive housing, and then the remainder of the dollars go into a general class. This year, we received 34 applications that totaled $15.2 million. We had a team of 6 that initially assessed these applications for thresholds. And similar to other competitive rounds that we run, there was a clarification period wherein the reviewer requested explanations regarding application documentation that may have been unclear. Upon conclusion of that clarification period, the reviewers conducted an initial point review. This year was different because after that initial point review was conducted, we had several layers of review after that initial point review. Point documentation was reviewed at the management level by the 2 team leaders of the program. We had our multifamily directors do a quality control review. And then simultaneously, our internal audit was doing a review of the program and of the round as well. So several layers of review this year. In summary, of the 34 applicants, 24 are slated to receive an award. 9 will be utilizing funds for supportive housing. 3 are going to capitalize revolving loan funds that will provide low-cost loans for the rehab or the construction of housing to benefit low and moderate individuals and families. And then the remaining 12 are going to either create or rehab both elderly and family housing throughout various towns and cities. I'm going to see if I can refer you to the application scoring list that's provided. Yes, there it is. Thank you. You'll see that there will be activity from Fairfield County all the way to Windham County. So we have various areas of the state that are going to benefit from these awards. And I think it's important to note what's not apparent from this list is the uniqueness of this program. The dollars are being used for an array of purposes. And just to give you a few examples, we have funds that are being used to renovate multifamily homes in blighted neighborhoods. We have awardees that are constructing new homes on vacant lots that have been eyesores to their neighborhoods for many years. We have one nonprofit that's using the dollars to renovate a residential facility for individuals that have recovered from substance abuse. And then some of the funds are assisting, Habitat for Humanity groups who work so hard to provide home ownership opportunities for people to actually wherein they're going to be a homeowner and they get to actually be involved in building their own home. So it's really good stuff. I think that is not apparent by looking at this list. These dollars are being used for some really good things. And the funds are vital for many of these small nonprofits that don't have the means to access other sources of funds. What you'll also see from this report here is that of the 34, 10 will not receive an award. 4 of them failed to meet thresholds. And what that means is, unfortunately, they did not submit the required documentation to actually be included in the round. After these awards are made, the awardee has 60 days to obtain a commitment to purchase the credits. Eversource has already expressed a strong interest in purchasing all of the credits, so we are hopeful that securing commitments is not going to be difficult for the awardees. In terms of compliance, the awardees have 3 years to use these funds, and we have strengthened our reporting requirements this year. In addition to a standard quarterly progress report that an awardee would usually submit, we are also requiring that they submit evidence of the use of funds, and that's in the form of a bank statement, along with invoices that substantiate the disbursements from that account. And then beginning in August, based on construction milestones, we're going to be having staff conduct site visits that require the nonprofit be present. I've been offering debrief calls to any of the applicants that want to improve their application going forward in the future. I'm also encouraging them to please provide me with feedback regarding their experience with the program, and I'm welcoming suggestions on how we might make it easier in the future. And it's also my goal to assemble a working group internally so that we can enhance this program for 2021. Any questions?
Michelle?
Yeah.
And the board doesn't vote on that.
That's correct.
Mm-hmm.
Well, that's not by a resolution.
Right, not by resolution, but typically it's been included as part of the consent agenda.
To accept the report.
Correct.
I'm just trying to understand all.
And I have a question.
Yeah, Lisa.
So, Michelle, would you be so kind to tell us, in the last few years, who other than Eversource has purchased any of these?
That's a good question. I know last year Norwich Public Utilities purchased credits, but generally it has been, from my knowledge, it's been Eversource.
People's Bank sometimes, do they ever? I mean, they're big tax credit buyers too, right? I mean, I know they issue, but maybe that's a different program.
Yeah, I'm not sure. It is the first year that I'm in charge of the program, and I did notice that in the few years past, it's been Eversource and Norwich.
There are there's restrictions in state who the buyer can be for these programs. So there's very, very few buyers that would qualify that have the right utility component. I've forgotten, we looked at this quite a bit last year when, from a legislative standpoint, but it's the number of companies that sort of fit this very narrow statutory rubric and also have the tax appetite for tax credits in the state is very, very small. And Eversource is pretty much it in that bucket. There's also a question of whether you might have some other, there might be a few other eligible buyers who would come in, but it does take a level of, as Michelle detailed, there's a level of knowledge and expertise that goes into doing this. You sort of have to have the intellectual bandwidth within your organization to complete these transactions and become the investor and process all of that. So Eversource is really has been the only buyer for these credits for some time, my understanding.
And Kylie, just maybe a question for you or Nandini, for whomever on your staff. Is that the way that other states also do this, or have we in Connecticut sort of created this narrow scope, and is that to our disadvantage, or is this just the way it always works?
I don't think I have enough knowledge to answer about other states. I know that our program is fairly unique, and I have been told a few times that we're kind of lucky to have this program because I don't think this program exists in this particular form elsewhere. So I couldn't answer that, but I will tell you that this is something that we're looking at in terms of whether there's a way to have conversations with other entities that may be interested in purchasing credits. I don't know if that means will that create demand in a way that, creates, better pricing. I mean, we do get a dollar per dollar credit. They get a dollar per dollar credit, and the credits are purchased for $1. In other words, they're not discounting the credit in any way. But if there's a way to create a marketplace, I don't have the answer to that. We'll have to do a little bit of research.
It's my understanding, Mrs. Kiley, that the dollar price is set program regulations here in Connecticut. So, we as a partnership, for example, did have some discussions last year, again, when this was a legislative issue, about if you could push the program to, first of all, more credits would be great. Like, we need more housing and historic tax credits. I think especially historics that are, not necessarily tied to restrictions that can be used for the state. But if it was set up more like a LIHTC marketplace where the credit price fluctuated and where you had a more open market for buyers and the allowable buyer type was so narrowly constricted, you may have less equity coming into these projects because the credit price could, or maybe you have more if you had more buyers competing for the credit. But right now it's at that, so it's a pretty stable program in that regard. So there's, I think, pluses and minuses to sort of both ways of doing it. The other states do it differently. Connecticut has a pretty good program, but again, I would say it's one of these programs where it would, if the state was interested in it, I think it would be a worthwhile consideration to expand it versus restrict it.
Yeah, just to say, I think that what we need to do also is probably to market to businesses, because Eversource has found a way to make money. They're not doing it because of the good of their heart. It's because they do make money. And I have had several conversations with them, and I think the person that is in charge, he is willing to basically explore marketing possibilities with other businesses, maybe with the Chamber of Commerce, for people really, and this is an accountant, also knowledge that they need to know. And usually the nonprofit developers don't have the expertise or the knowledge to go out and to market it the way that a business can attract business. So I think that it's a good program. It's a very flexible program, and we might have to think about how we can provide that some support, the expertise that the nonprofit can go and reach out to some businesses. So maybe engage Eversource to help understand some of the businesses what they gain in these credits are.
Other questions or comments on the report?
So, Michelle, when we look at the applicant pool, so 10 did not receive an award. Do those applicants stay active? And then each round, how many participants are interested around the state, when you take all the rounds as a total?
You mean stay active? They would have to reapply again next year. Yeah.
How many maintain interest?
Quite a few.
And what is the overall size of the interest in this?
This year, for some reason, it was a little bit smaller. Again, I'm new to this program. There were probably about 20 additional applications last year than this year. There were fewer this year, but we're always we've always been oversubscribed for the past few years that I'm aware of. So the interest is definitely there, and we do get many repeat applicants. And they also, one of our procedures allows them to come in 3 consecutive years. So if they have a housing program, they can come in this year, but then they can also come in 2 consecutive years after that for the same housing program. So they're maxed at $1.5 million, and they're maxed at $500,000 per year.
Thank you.
You're welcome.
Are there other questions for Michelle? Comments, concerns? Okay, so we don't have to vote on this. And if there's nothing else, then we might move on to the next agenda item. We have about 15 minutes, I think, for the last couple of items. And Masuda is going to tell us about the National Council of State Housing Agencies Credit Connect update.
Good morning, Mortgage Committee, and great welcome to Mortgage Committee and the board. Before I do that, I do want to share the interest rate for Macedonia townhouses. Their current interest rate is at 3%. So I just wanted to share that with committee in case for your information. So, National Housing Council of Agencies, they're the trade association for housing and finance agencies. They typically host their annual credit conference in June. This year's conference was going to be held in St. Louis. However, because of COVID, CHFA instead convened the session virtually and also made it complimentary to all of the HFA members, which was very gracious on their part. And as a result of that, we were able to have increased participation by CHFA staff. The other thing that I would just mention about NCSHA, they have been wonderful to their support during the pandemic. They have been working as an intermediary between the IRS, HUD, HFAs, and convening calls. In fact, in addition to the Credit Connect call, there have been a few other calls since that time to convene with HFAs and share best practices, trends, compliance issues. So we value their partnership and support. So some of the items that I'm going to share with you that I felt it would be noteworthy. However, some of this is based on a snapshot. So some of these conversations occurred in late May, early June. So it may not be as relevant, but I'll try to incorporate updates as necessary. So on the development side, there was a lot of conversation about Congress, if they lock in the 4% rate for the tax credit program, that has the potential of producing hundreds and thousands of new affordable units in the country. And then specifically for Connecticut, that would result in about a little over 1,200 units over the next 10 years. So as you know, Congress has not acted on that yet, so we're closely monitoring to see if the 4% rate will be locked. The other thing that was interesting is, and again, this is consistent with our observation here in Connecticut, that the impact of COVID have been still somewhat minimal because of the availability of stimulus dollars. There was a lot of conversation about, well, what happens when stimulus funding runs out, or rent concessions, those kinds of things. So I think everybody's kind of staying tuned and seeing what the next few months will look like. But they also felt like subsidized properties, senior properties did much better than tax credit family properties. They also noted that for a while, construction paused, but construction has resumed. Investors are certainly being cautious when it comes to developments that are undergoing renovation as opposed to new construction. They're definitely applying more scrutiny, and that's something we also heard when we held the investor panel here recently. There's definitely a drop in equity pricing for the newer deals, so there was some discussion around that. I would say in terms of on the forbearance side, the feedback that they shared, again, was very similar to CHFA's observation. A lot of the HFAs offer the forbearance program due to COVID. Many of their borrowers decided not to take. Some did, but we didn't see the kind of volume that originally folks were anticipating. There are also just concerns in terms of the ongoing impact, what it's going to do as far as lease up for new construction. So again, that's something that everyone is continuing to monitor. There was some conversation around design. Should a design look different? Should there be like work areas, with balconies, smaller common space? For example, with senior development, we tend to see more common space because it's great for gathering space and opportunity for, collaboration and conversation. And at a time like this, that may not be such a good idea. So some of this is hard to tell whether these are kind of short-term view of the situation or whether there will actually be some design changes down the road because of, making sure that we're prepared for if there is a future crisis like COVID. In addition, when we were talking with some of the other HFAs during the conference, we had not received all of the guidance from the IRS, so there was a lot of conversation as far as compliance monitoring, physical inspections, how should we be doing it. But since that time, IRS has issued guidance, and so that has been helpful as far as providing some clarity. Similarly, on the HUD side, a lot of those inspections had been suspended, but we're hearing that HUD is now looking to resume MORs as well as physical inspections. So again, we're monitoring that closely. I think the other thing that I would just note, there was consensus across the board as far as need for automation and technology solutions, not only at the HFA level, but certainly with property owners, that today's technology has been limited in terms of, mass communication and, providing updates or electronic, signatures, electronic online forms, those kinds of things. A lot of the residents, we deal with physical, paperwork. So there was a lot of talk about that, like how do we move towards automation and electronic forms just to make this process easier going forward. They talked about, do we need like cloud-based technology? Is there opportunity for like online portals? Again, communication system, those kinds of things. And so remote signing, virtual electronic file reviews. So those are things that I think over time will become standard part of our business, but certainly the COVID really kind of shook the industry, and it's going to force us to look at innovation and automation as we move forward. So those were just some of the highlights that I wanted to share with you, and happy to answer any questions.
This is Anne, and I appreciate the verbal update. I'm just wondering if you can comment on the reason that there wasn't anything in writing for us. Was that the timing of when the meeting was, or is there another reason?
No, there was really no reason for not providing a written update. This was, it was just a decision to give you a verbal update, and I'd be happy to, just send you my notes in writing after the board meeting if you like.
No, I would just say going forward, especially with us being remote, it's a little harder to focus sometimes.
Sure.
People coming to the door and text messages coming in, and when we're all together, it's a little bit easier. But my preference would be that where we can on the agenda going forward, even if it's just a one page, with bullets. So we're not, trying to take notes on what you're saying. That would be really helpful to me.
Absolutely. No, I appreciate the feedback, and we will do that going forward.
Other comments, questions, things for Masuda on her report? Okay. Thank you very much. Appreciate that. And next, we have Wendy to tell us about multifamily activities.
Good morning again. I'm going to keep this brief because I know there's still another report and we're running out of time. I did include the 4% application pipeline again. As you can see, there are 16 applications in various stages of review. 7 of those have been approved by the board and are working towards an initial closing. There are 5 that will be presented to the board later this year or beginning of next year. And then, as discussed in the past, some of those just require our review because of the tax credits, so we aren't doing the financing. And so 4 of those are being looked at for the 42M process. We didn't have any initial closings in this. There were final closings. Staff attended a few webinars during the Partnership for Strong Communities, hosted 2 more listening sessions, one that Masuda just mentioned with syndicators and equity investors, and the second one was again with developers to get their take on the ongoing impact of the pandemic on development. We talked last month, there was a NOFA for the state-sponsored housing portfolio to establish basic need pantries at their developments. We had 31 applications, 15 of those have been approved and executed, and the rest are still under review. Tomorrow is the last day for us to receive applications for that amount of funding. As we talked about last month, Terry talked about the Capital Magnet Fund. That application was submitted earlier this week. As we talked about, CHFA applied for a $4 million grant, and we'll match that with $4 million of ITA funds if we're awarded. And announcements are anticipated early next year. CHFA staff continues to work closely with DOH staff on the development engagement process, and we've reported in the past that 133 developers had responded to that. We've completed all the calls with the SSHP properties that had responded, and we're working on the 4% tax credit calls. Many of those have taken place, but those will continue through August. So we've had a lot of those on our calendars. Are there any questions that I can answer? Questions for Wendy?
Yeah, this is Kylie. It would be helpful, I know these are projects that are already in the pipeline. It would be helpful, I think, as we're looking at this periodically, to see the Affordable Housing Appeals List 830G percentage for the town in here, if you're not opposed to putting that in. You don't see it here.
Okay.
Just noting for the record that, again, there's only 2 of these projects that are in towns with less, that I think that are less than 10%. And I think, given the discussions we've been having at the QHB and policy level, that it's something that's useful to keep an eye on. Noting, too, that I think like Newton is right around that point, that there are towns here that may go up or down over time, and I think it's helpful to see that and note those changes as we're making decisions about future projects also.
Okay.
Thanks, Patty. That's helpful. Any other questions, Wendy? Okay.
Thank you.
All right. So it looks like now we've split out this report, and Joe is going to give us the upcoming multifamily pipeline, which I guess was different than the multifamily activity.
So really quickly, sorry to interrupt, but Joe, if you would explain to the committee that going forward we will have a written report. This is a verbal update, but again, with Ann's comment about the prior verbal update, we're going to create a report around this as well moving forward.
Yes, absolutely. So good morning, everyone. I will be quick and brief. The intent of this is to establish this new report that would give you an indication of what the Mortgage Committee board is likely to see as coming to the board in the next board meeting or 2. That would sort of give you a preview of the projects and the types of financing and programs that are coming up. As you all know, there is no board meeting in August, so we actually have 4 projected board actions for September. 2 are very exciting. They are permanent-only financing for some previously funded 9% transactions. Historically, we haven't provided a lot of financing for the 9% transactions, but We're excited to be able to do this because I think it provides a balance of allowing better equity pricing when investors and lenders are involved, but also have the opportunity for us to finance some of these very high quality developments in some terrific areas. So we'll see a couple of those, one for 540 New Park, which you'll recall from this past April's 9% round, and Willow 3, which was a previous 9% transaction in Hartford. Both will be coming in September. We'll also have 2 preservation transactions, one for Market Square Apartments in Newington and Mapleview Towers in Stamford. Both are getting acquired from the related companies and will be seeking permanent, acquisition and permanent financing from CHFA. So you'll see all full board actions in September.
Okay, thanks, Joe. But I'm not clear about the need to break this out into two different reports. But if that's what works better for staff, I guess it's fine. And I actually did want to just take a second to thank staff for being so prepared and so knowledgeable, as always, and also just a little shout out to Shelley. I'm on a lot of boards, and I think Shelley does a great job in terms of keeping up on the screen, you know, what exactly we're talking about. So I just wanted to note that. But are there any questions for Joe? I think we need to move fairly quickly into the board meeting. And
do we need to redial, or is it the same? Is it the same passcode and ID number?
No, it isn't. There's a whole new ID and password.
Okay, so I would entertain a motion to adjourn the meeting of the Mortgage Committee.
So moved.
Moved by Greg and seconded by Kylie. All in favor to adjourn?
Aye.
Great, adjourn. Thank you all very much.
Thank you.